Okay, so in this video, we're going to take a look at purchase discounts. And as I said at the end of that last video, there's two different types. We can have a quantity discount or a purchase discount. Quantity discounts are also called volume discounts. And this happens when you purchase a large amount of something. So the greater the quantity that you purchase, the lower the price per item. So you see this in real life quite often. I know, I feel like every time I get groceries lately, there's these kind of quantity discounts at Walmart. So chips, for example, you often see in the aisle. Buy 3 for $6, or they're each $2.75. So if you buy 3 bags, they give you the discount. You only have to pay $2 per bag to get to that $6. But if you only buy 1, you pay $2.75. So the more that you're buying, the lower the price that you get. That's just a really small example you've likely seen. But a company who buys a bunch of inventory from a wholesaler, they could buy or get these quantity discounts at different levels. So if they buy 100 of something, maybe they pay one price. If they buy 200, they pay another price that's lower. 300, they get an even lower per item price. So these are those quantity discounts. The more you buy, the lower the price per item. A discount like this is right on the face of the invoice. So it's seen as part of the original purchase. Because of this, there's actually nothing that needs to be recorded separately or no adjustment that's needed. So when you buy this higher quantity, you just book the lower price per item. So it's part of that original purchase, and it would just be recorded that way when the purchase occurs. Now, the second type of discount is called a purchase discount. And these are ones that do need to be recorded separately. So a purchase discount is a discount off the selling price for prompt payment. So you pay something within a shorter period of time than it's actually due, they will give you this discount. So this is done, or it's offered to encourage early payment. So suppliers want to collect that money from the purchaser early, and they give this encouragement or motivation by offering a discount if this is done. So if a purchase discount is available, they are stated in terms, these credit terms, expressed in a form like this. So 2/10, N30. And what this means, I'm just going to erase this quick. So this 2 here goes with a 2% discount. So it means, just to read it fully through the first time, the 2/10, N30 means that there's a 2% discount if you pay within 10 days from the invoice date. Otherwise, the net amount is due within 30 days. So the 2 that I've had the square around here is the discount percentage that you would receive. The 10 is how many days you need to pay from the invoice date in order to get whatever the stated discount is. N always means net. And then the 30 is how many days it's overall due in. So regardless of whether you're paying early or not, it's due within 30 days. So again, you receive a 2% discount if you pay within 10 days. If not, the net amount is due within 30 days. So a question in the textbook, you'll see the terms stated like this, and you need to know what those mean to determine if you are paying within that discount period. And something else you may see in the textbook here is this N/EOM. And that means the net is due at the end of the month. So that's another way you may see it written, rather than in a certain amount of days, like the M30. Here it's just saying the net's due at the end of the month. Okay, so when you have a purchase and you have credit terms listed like this, you still record the full payable when the purchase occurs. Because when you're purchasing it, you don't know for sure if you're going to be able to pay that within the discount period. And therefore, you need to set up the full payable. So you record a debit to inventory, a credit to AP for the full price. Then, in the future, if you do pay within that discount period, so the 10 days in our example above, you do an adjustment that's made separately. So then later when you actually pay early, you have this adjustment. Okay, so let's look at an example here. So this is a new example. On June 10th, Joe's Sporting Goods purchased $700 of inventory on account with credit terms of 2/15 and 30. So again, this means a 2% discount is available if it's paid within 15 days. And if not, the net is due in 30 days. So that's how you read those. So the journal entry that we need to record the original purchase. So again, I've said when you record the original, you book it at the full amount because we don't know if we'll get the discount or not. So on June 10th, when we make this purchase, we debit inventory for the full $700 and credit accounts payable for that full amount. Because as of right now, we still owe the full amount. We don't know if we'll pay in the discount period. To record purchase. Okay, so that's the first purchase. Now it comes to June 20th, and Joe's Sporting Goods pays the invoice on June 20th. So we need to now record the payment. So the first question you ask yourself when you have an AP amount that has these credit terms is, did we pay within the discount period? So you want to ask, did we pay within the discount period? Which in this case was 15 days. So we made the purchase on June 10th. We had 15 days to pay in the discount period. That means that we had until June 25th. We are actually paying on the 20th. So we're paying within that discount period. So this is a yes. We did pay within the discount period. Therefore, we need to make an adjustment. So first we can calculate the discount amount that we're going to receive. So the invoice was $700. Whoops. And we're going to multiply that by 2%. That is the discount that we get. 700 times 2% equals a $14 discount. Okay, so now we're paying off this invoice. So there's going to be 3 parts to an entry like this. First off, if we were to pay off anything on account, our debit is always to accounts payable. Because we set up the AP when we purchased it, when we recorded that purchase. Now we need to get rid of this. And we're going to remove the full $700. So that was what we set up on June 10th. And now we're paying off, or we're dealing with this whole invoice. Therefore, we need to get rid of the full amount of AP. And since we're making a payment, we know we will also credit cash. But here, we're only going to pay the discounted amount. So we have the $700 that was originally due, but we subtract the $14 discount that we calculated. So we're actually only going to pay cash of $686. So that's the discounted amount. So is our journal entry done here? Well, we know our debits need to equal our credits, and we do not have that. So we can tell that we still need a credit for $14. So that is the discount amount. And because we received this discount, we're ending up paying less for the inventory that we purchased. And because the cost of our inventory went down, we credit the inventory account to show that reduced price. So these will always be the types of entry you see if you've paid within the discount period. You get rid of the full amount of AP. You record the discounted amount of cash, and then you credit inventory for the discount amount. And you put your explanation here to record payment within discount period to show why we're reducing the inventory here. So again, this is the perpetual method. We always want our inventory cost amount or our inventory account up to date. Since we received this discount, we again credit the inventory to update that amount. Okay, so now let's continue on another example here, but we're going to continue with ABC Company that we've already looked at. So on April 26th, we recorded the purchase of $5,000. Then on the 30th, we returned $800 worth of goods. This was the entry we booked. And on May 1st, we received an allowance for $75. So we kept that slightly damaged good, but we had the reduction in price. So now the entry we're going to look at now, number 4, says that the necessary payment was made on May 8th. And the purchase on the 26th, so this number 1 up here, had credit terms of 3/20 net 30. So a 3% discount was available if we paid within 20 days. Otherwise, the full amount was due, or the net amount due, in 30 days. So we need to record this entry. So again, I've said whenever we have something going on where we have a purchase that has credit terms, the first question we need to ask is it paid within the discount period? So what do you think on this one? Did we pay within the discount period? The original purchase was on April 26th, and it's now May 8th. So if we figure out the days, we've got the 27th, 28th, 29th, 30th of April, so 4 days in April, plus 8 days in May, means that we've paid within 12 days. Well, based on our credit terms, we had 20 days. So if we paid in 12, then yes, we did in fact pay within the discount period. Okay, so we know that. But the second question you need to ask is how much is actually owed at this point? So how much is still owed? So we need to track what's happened so far based on this purchase. So we purchased an amount, but then we returned something and got an allowance. So we need to keep track of all of those to know when we actually get to May 8th, what amount do we need to pay? So the best way that I like to do this is just in a quick T account. So the original purchase, we credited AP for $5,000, but then we had the return for $800, which reduced that. And then on May 1st, we had the allowance. So that also reduced the amount we needed to pay. So after these 3 transactions have happened, we're left with $4,125 that's actually owing on this invoice. So that's going to be the amount that we're going to work with. So we know we've paid within the discount period, so we can calculate our discount. And we're going to use only the balance that's still remaining. So the $4,125, we multiply that by the 3% that we get from our credit terms. We multiply that out, our discount amount is $123.75. So this is our discount. And now we go ahead and we record the entry as we did earlier. So we're going to debit our accounts payable. And now we get rid of the full amount that remains. So the $4,125. So if you forgot to keep track of the return and the allowance, you'd likely just be looking at the $5,000. But you need to be really careful about what else has happened related to this purchase. So track any returns, any allowances that occur after. So we debit AP for the full $4,125. We know our discount amount is $123.75. And that discount means we're paying less, so we decrease the cost of our inventory, so credit inventory. And we're paying this invoice off, so our credit will be to cash. And we take the $4,125 minus our discount amount. So the cash that we'll actually pay is $4,001.25. So again, this is May 8th to record payment in discount period. Okay, that's a look at the purchases side as well as returns and allowances, and now if we pay within that discount period and we get a purchase discount. So below this video, I'll make note of a couple of example questions, or at least one. So go ahead and try that on your own, and then I'll post a solution video going through those. But try them on your own just to see how your understanding is.